What if everything you've been taught about money is wrong? What if the difference between struggling financially and becoming truly wealthy isn't about luck, talent, or even hard work, but the way you think? Why do billionaires seem to play a different financial game than everyone else? How do they see money, risk, and opportunity in ways that most people never even consider? In today's video, we're pulling back the curtain on the billionaire mindset, the exact beliefs, habits, and mental frameworks that separate the ultra-rich from the rest of the world. And if you think it's all about having millions to start with, think again. Many self-made billionaires started with nothing, but they all shared certain key principles that led them to financial success. Stick around, because we're about to reveal heavy checkmark the counterintuitive wealth-building secrets the rich use daily. Heavy checkmark why index funds are one of the simplest, yet most powerful investing strategies. Heavy checkmark a definitive action plan to take control of your financial future. And most importantly, how you can start applying these principles today, no matter where you're starting from. Let's dive in.
Now we move into the realm of the ultra-rich, the billionaires, the financial titans who have mastered the game of money at the highest level. In Section 3, we're going to peek inside their minds and unlock their secrets, uncovering how they think about money, wealth, and success. Tony Robbins sat down with billionaires from diverse industries, finance, technology, real estate, and more, to understand their unique mindset and operating principles. These aren't just tips or tricks. They are fundamental shifts in perspective that drive extraordinary wealth creation. Get ready to absorb the wisdom of billionaires. Secret number 1. The stock market is a money machine for those who stay in it long-term. Warren Buffett. Let's start with the Oracle of Omaha, Warren Buffett, one of the greatest investors of all time, with a net worth in the hundreds of billions. Buffett's secret number 1, in his own words, is, the stock market is a money machine for those who stay in it long-term. This secret is deceptively simple, yet profoundly powerful. It reinforces the critical importance of long-term perspective in investing. Buffett is not a short-term trader or speculator. He's a patient, long-term investor who understands the power of compounding over decades. Buffett's success is built on buying and holding great companies for the long haul, through market ups and downs. He doesn't panic during market crashes. He sees them as opportunities to buy more at lower prices. He understands that time is his greatest ally in the stock market. The billionaire secret here is patience and long-term vision. Don't treat the stock market like a casino or a get-rich-quick scheme. See it as a long-term wealth-building machine, and stay in the game, consistently investing and reinvesting dividends for decades. Embrace the long-term and unlock the billionaire secret of Warren Buffett. Secret number 2. Never depend on a single income stream. Jeff Bezos. Next, let's look at Jeff Bezos, the founder of Amazon, a revolutionary entrepreneur and another centi-billionaire. Bezos' secret number 2 is, never depend on a single income stream. This secret highlights the billionaire's focus on diversification and resilience, not just in investments, but also in income sources. Bezos, even while building Amazon into a global empire, understood the importance of multiple income streams to mitigate risk and maximize opportunities. Relying solely on one income stream like a single job is financially vulnerable. If you lose that job or that income stream dries up, you're in trouble. Billionaires understand the power of diversification to create financial security and opportunity. Build multiple income streams. This could include active income, your job or business your primary income source, but not your only source. Side hustles and part-time businesses, generating extra income from side projects or small businesses. Passive income from investments, income from dividends, rentals, royalties, etc., as discussed in Step 6. The billionaire secret here is diversification of income. Don't be financially dependent on just one source. Create multiple streams of income to build greater financial security, resilience, and abundance. Diversify your income and unlock the billionaire secret of Jeff Bezos. Secret number 3, invest in assets, not liabilities. Robert Kiyosaki. Now let's turn to Robert Kiyosaki, author of the best-selling book Rich Dad Poor Dad, a master of financial education and entrepreneurial wealth building. Kiyosaki's secret number 3 is, invest in assets, not liabilities. This secret is about understanding the fundamental difference between assets and liabilities and prioritizing asset acquisition to build wealth. This is a core principle of the wealthy mindset. Assets are things that put money in your pocket. They generate income or appreciate in value. Examples: stocks, bonds, real estate, rental properties, businesses, royalties, etc. Liabilities are things that take money out of your pocket. They cost you money over time and don't generate income. Examples: consumer debt, credit cards, car loans for depreciating cars, excessive mortgages on personal residences if they don't generate rental income, etc. The poor and middle class tend to focus on acquiring liabilities, thinking they are assets. They buy fancy cars, big houses beyond their needs, and consumer goods on credit, draining their wealth over time. The rich, in contrast, focus on acquiring assets. They prioritize investments that generate income and appreciate in value. They understand that true wealth is built by accumulating assets that work for them. The billionaire secret here is the asset versus liability mindset. Shift your focus from accumulating liabilities to acquiring assets. Every dollar you earn, ask yourself, is this going to buy an asset or a liability? Prioritize asset acquisition to build lasting wealth. Master the asset mindset and unlock the billionaire secret of Robert Kiyosaki. Secret number 4, know your circle of competence and stick to it. Warren Buffett, again. Let's go back to Warren Buffett for secret number 4. This secret, again from Buffett's wisdom, is know your circle of competence and stick to it. This secret emphasizes the billionaire's discipline and focus on investing in what they truly understand and avoiding areas outside their expertise. Buffett is famous for investing in businesses he understands deeply, like Coca-Cola or American Express, and staying away from industries he doesn't grasp, like technology and the early dot-com boom. Your circle of competence is the area where you have genuine expertise, knowledge, and understanding. It could be your profession, an industry you've worked in, or an area you've deeply researched and studied. Don't invest in things you don't understand just because they are hot or someone else recommends them. Stick to your circle of competence. Invest in businesses, industries, or asset classes that you genuinely understand, their fundamentals, their risks, their potential. It's okay to say, I don't know, and pass on investments outside your circle of competence. Ignorance is not bliss when it comes to investing. It's financial suicide. Warren Buffett famously said, risk comes from not knowing what you're doing. The billionaire secret here is focus and discipline within your circle of competence. Identify your areas of genuine expertise and concentrate your investments there. Avoid the temptation to chase shiny objects or invest in things you don't understand. Know your circle and stick to it to minimize risk and maximize your chances of success. Master the competence secret and unlock another billionaire key. Secret number 5. Be fearful when others are greedy and greedy when others are fearful. Warren Buffett, yet again. Yes, we're back to Warren Buffett for secret number 5, because his wisdom is so profound and timeless. This secret is a classic contrarian principle. Be fearful when others are greedy and greedy when others are fearful. This secret reveals the billionaire's ability to be contrarian, to go against the crowd's emotions, and to see opportunity where others see only fear or excitement. This is a hallmark of successful investors. When the market is booming and everyone is greedy and euphoric, buying stocks indiscriminately and driving prices up to unsustainable levels, that's when a billionaire gets fearful and cautious. They recognize that irrational exuberance often leads to bubbles and crashes. Conversely, when the market crashes and everyone is panicking and fearful, selling stocks at fire sale prices, that's when a billionaire gets greedy and optimistic. They see market downturns as opportunities to buy great companies at bargain prices. This contrarian mindset requires emotional discipline and independent thinking. It's about resisting the herd mentality and making decisions based on logic, value, and long-term fundamentals, not on emotional impulses or crowd psychology. The billionaire secret here is contrarian thinking and emotional control. Train yourself to be contrarian. Be fearful when the crowd is greedy, and be greedy when the crowd is fearful. This is how you buy low and sell high and build wealth by capitalizing on market cycles. Master the contrarian secret and unlock another billionaire advantage.
All right, you've absorbed powerful knowledge about money lies, freedom steps, and billionaire secrets. But knowledge without action is just potential unfulfilled. In Section 4, we're going to bridge the gap from theory to reality with your definitive action plan. This isn't just generic advice. It's a 7-step action plan based on the principles we've discussed, designed to be practical, actionable, and customizable to your unique situation. No more excuses. It's time to take control and start building your financial freedom, starting right now. Let's get into action mode. Action Step 1. Declare your investor status today. Remember step 1 of the 7 steps to freedom. Make the decision to be an investor, not just a consumer. Well, action step 1 is simple but crucial. Declare your investor status today. Make a conscious and deliberate decision right now to shift your mindset from consumer to investor. Say it out loud. I am an investor. My money will work for me, not just the other way around. Write it down. Put it in your journal, your notes app, wherever you keep your goals. I am committed to becoming a successful investor and achieving financial freedom. Make it official. This declaration is a powerful psychological trigger. It shifts your identity and primes your mind to start making choices that align with your new investor status. It's the first and most important action you can take. Declare your investor status today and take the first step towards financial transformation. Action Step 2. Calculate your freedom number this week. Remember Step 2. Know your real numbers, your freedom number. Action Step 2 is to calculate your freedom number this week and no excuses. Don't procrastinate. Don't say, I'll do it later. Block out 30 to 60 minutes this week. Sit down and do the math. Grab a pen and paper or use a spreadsheet and follow the simple steps we outlined in Section 2. Calculate your monthly expenses, project your desired lifestyle, and use the 4% rule to determine your freedom number. Be honest with yourself about your expenses and your lifestyle aspirations. Having your freedom number clearly defined will give you a target to aim for, a measurable goal to motivate you. It's like having a destination set in your GPS. You can't reach your destination if you don't know where you're going. Calculate your freedom number this week and get clarity on your financial target. Action Step 3. Automate your savings. Start small, aim high. Remember Step 3. Save like the 1%. Action Step 3 is to automate your savings, starting small but aiming high. Set up automatic transfers from your paycheck to your investment account, starting this month. Even if you start with just 5% or 10% of your income, the key is to automate it and make it consistent. You can always increase the percentage later as you get more comfortable. Contact your HR department or your bank and set up automatic transfers to a dedicated investment account. Make it happen this week. Don't wait for the perfect time or until you have more money. Start small, start now, and automate it. Treat your future financial freedom as a non-negotiable bill, just like your rent or utilities. Pay yourself first automatically. This is the secret to consistent savings and building momentum. Automate your savings now and build the foundation for your financial future. Action Step 4. Open a low-fee index fund account next week. Remember Step 4. Become an insider, understand fees and hidden costs. Action Step 4 is to open a low-fee index fund account next week. Stop letting fear or overwhelm paralyze you. Opening an investment account is easier than you think. Research reputable online brokers that offer low-fee index funds. Companies like Vanguard, Fidelity, Schwab are great options. Do your own research and choose one that suits you. Compare their fees, account minimums, and user-friendliness. Go to their website, follow the simple online application process, and open your account next week. You can often fund your account with as little as $10 or $50 to start. Don't let the complexity of investing intimidate you. Opening an index fund account is remarkably simple and accessible. The most important thing is to take action and get started. You can learn more about investing as you go. Open your low-fee index fund account next week and overcome the inertia. Action Step 5. Choose your asset allocation model this month. Remember Step 5. Asset allocation, your secret weapon. Action Step 5 is to choose your asset allocation model this month. Don't leave your investments to chance. Be strategic about diversification. Research different asset allocation models, like Ray Dalio's all-weather portfolio we mentioned in Section 2 and 3. Understand the different asset classes, stocks, bonds, commodities, and how they work together. Determine your risk tolerance and time horizon. Are you young and have a long time until retirement? You can likely take on more risk with a higher allocation to stocks. Are you closer to retirement and more risk-averse? You might prefer a more conservative allocation with more bonds. Choose an asset allocation model that aligns with your goals, risk tolerance, and time horizon. You can find sample asset allocation models online from reputable financial institutions. Pick one that makes sense to you and implement it in your index fund account this month. Don't get paralyzed by analysis paralysis. Choose a reasonable asset allocation model, implement it, and you can always adjust it later as you learn and your circumstances change. Choose your asset allocation model this month and become a diversification master. Action Step 6. Brainstorm lifetime income streams this month. Remember Step 6. Create a lifetime income plan. Action Step 6 is to brainstorm lifetime income streams this month. Start thinking creatively about how you will generate passive income to reach your freedom number. Make a list of potential passive income sources that interest you and align with your skills and resources. Consider options like rental properties, dividend stocks, creating online courses or content, starting a side business that can eventually become passive, etc. Brainstorm as many ideas as you can without judgment. Start researching 1 or 2 promising passive income ideas that you can realistically start implementing in the next 3 to 6 months. Don't try to do everything at once. Focus on taking action on 1 or 2 streams initially and build from there. Your lifetime income plan is a long-term vision, but it starts with small, concrete steps today. Brainstorm lifetime income streams this month and start building your money-generating machine. Action Step 7. Commit to lifelong financial education. Start today. Remember Step 7. Pay it forward and leave a legacy. But before you can effectively pay it forward, you need to commit to lifelong financial education yourself. Action Step 7 is to commit to lifelong financial education starting today. Financial freedom is not a one-and-done destination. It's a lifelong journey of learning, growth, and adaptation. The financial world is constantly evolving, and you need to be a lifelong learner to stay ahead of the game and maintain your financial freedom. Commit to spending at least 30 minutes a week on financial education. Read books on personal finance and investing, like Money, Master the Game. Follow reputable financial blogs and podcasts. Watch educational YouTube channels like Sabiduria and Palabras Winking Face. Take online courses, attend seminars, find a mentor. Make financial education a non-negotiable part of your weekly routine. The more you learn, the more you earn, and the more secure your financial future will be. Commit to your lifelong financial education today and embark on a journey of continuous financial growth and empowerment.
Now we arrive at one of the most practical and powerful tools for building long-term wealth, especially for beginners: index funds. In Section 5, we're going to provide your definitive guide to index funds, demystifying them and showing you why they are a simple, effective, and low-cost way to invest in the stock market and beyond. If you're feeling overwhelmed by the complexities of investing or unsure where to start, index funds are your answer. They are the secret weapon of many savvy investors, including billionaires like Jack Bogle, the founder of Vanguard and a pioneer of index fund investing. Let's unlock the power of index funds for you. What exactly are index funds? Simplified. So, what exactly are index funds? Let's break it down in simple terms. Imagine the S&P 500. It's a list of the 500 largest companies in the United States stock market. It's like a snapshot of the overall US economy. When people talk about the market is up or the market is down, they are often referring to the S&P 500. An index fund is like a basket that holds all the stocks in the S&P 500 or another market index, in the same proportions as the index. So, if Apple is 7% of the S&P 500, your index fund will hold approximately 7% of Apple stock. If Microsoft is 6%, your fund holds 6% of Microsoft, and so on for all 500 companies. When you invest in an S&P 500 index fund, You are essentially buying a tiny slice of ownership in all 500 of those major companies, with just one single investment. It's instant diversification at its finest. Think of it like buying the entire basket instead of trying to pick individual apples. Instead of trying to guess which individual stocks will go up or down, which is incredibly difficult even for professionals, you simply invest in the entire market as a whole. It's simple, diversified, and historically very effective for long-term growth. Why are index funds so powerful? 5 key benefits. Now, why are index funds considered such a powerful investment tool, especially for beginners? Here are 5 key benefits. Benefit number 1. Instant diversification. As we just explained, with one investment, you instantly own a piece of hundreds or even thousands of companies, depending on the index your fund tracks. This diversification reduces risk significantly compared to investing in individual stocks. You're not relying on the performance of just a few companies. You're investing in the broad market. Benefit number 2. Low fees and expenses. Index funds are passively managed, meaning they simply track an index and don't require expensive fund managers to actively pick stocks. This translates to dramatically lower fees compared to actively managed mutual funds. Lower fees mean more of your money stays invested and compounding for you over time. Fees can eat away at your returns significantly over decades, so low fees are a huge advantage. Benefit number 3. Historical outperformance versus managed funds. Surprisingly, most actively managed mutual funds, even the expensive ones, fail to consistently beat the market index funds over the long term. Study after study shows that a large percentage of actively managed funds underperform their benchmark indexes, especially after fees are factored in. Why pay higher fees for potentially worse performance? Index funds offer a simple and effective way to capture market returns, often outperforming the experts. Benefit number 4. Simplicity and ease of use. Investing in index funds is incredibly simple and easy, even for complete beginners. You don't need to be a financial expert or spend hours researching individual stocks. You can open an index fund account online in minutes and set up automatic investments. It's investing made simple and accessible to everyone. Benefit number 5. Long-term performance and growth. Historically, the stock market, as represented by indexes like the S&P 500, has shown a strong upward trend over the long run, despite market fluctuations and downturns. Index funds allow you to participate in this long-term growth of the economy and benefit from the power of compounding over decades. They are designed for long-term wealth building, not get-rich-quick schemes. Different types of index funds. Choosing what's right for you. While S&P 500 index funds are popular, there are many different types of index funds that track various market segments and asset classes. Choosing the right index fund depends on your investment goals, risk tolerance, and desired asset allocation. Here are some common types. S&P 500 index funds. Track the S&P 500 index, representing the 500 largest U.S. companies. Broad U.S. stock market exposure. Total stock market index funds. Track the entire U.S. stock market, including large, medium, and small companies. Even broader U.S. stock market exposure than S&P 500. International stock market index funds. Track stock markets in developed countries outside the U.S., like Europe, Japan, etc., or emerging markets like China, India, etc. Diversification beyond U.S. markets. Bond index funds. Track bond markets, which are generally less volatile than stocks and provide income. Diversification into fixed income. Total bond market index funds. Track the entire U.S. bond market. Broad bond market exposure. Target date retirement funds. Funds of funds that automatically adjust their asset allocation. More stocks when young, more bonds as you get closer to retirement, based on your target retirement date. Hands-off, all-in-one retirement investing solutions. For beginners, a simple and widely recommended approach is to start with a broad market index fund like an S&P 500 or total stock market index fund, or a target date retirement fund if you are investing for retirement. As you become more knowledgeable, You can explore other index fund options to further diversify your portfolio according to your asset allocation strategy. The key is to choose low-fee index funds that align with your overall financial plan. How to invest in index funds. Step-by-step guide for beginners. So, how do you actually invest in index funds? Surprisingly simple. Here's a step-by-step guide for beginners. Step 1. Choose a reputable online broker. You need a brokerage account to buy and sell index funds. Research reputable online brokers known for low fees, user-friendly platforms, and good customer service. Examples include Vanguard, Fidelity, and Schwab. Again, do your own research and choose what's best for you. Step 2. Open an account online. Go to the broker's website and follow their online account opening process. It typically involves providing personal information, verifying your identity, and linking your bank account. It's usually quick and straightforward. Step 3. Fund your account. Transfer money from your bank account to your brokerage account. You can usually do this electronically via bank transfer or ACH. Start with whatever amount you are comfortable with. Many brokers have no minimums or very low minimums to start. Step 4. Research and choose your index fund. Use the broker's research tools to find low-fee index funds that match your investment goals and desired asset allocation. Look for funds with expense ratios fees below 0.2% if possible. For beginners, starting with an S&P 500 index fund, ticker symbol VOO, SPY, IVV for example. These are just examples. Research current tickers, or a total stock market index fund, VTI for example, is often recommended. Or consider a target date retirement fund based on your estimated retirement year. Step 5. Place your trade and start investing. Once you've chosen your index funds, enter a buy order on the broker's platform to purchase shares of the fund using the money in your account. You can buy in dollar amounts, e.g., buy $50 of VOO, or in share amounts, e.g., buy 2 shares of VOO. Confirm your trade and congratulations, you are now an index fund investor. Step 6. Set up automatic investments. Highly recommended to make investing consistent and effortless. Set up automatic recurring investments. You can schedule regular automatic purchases of your index fund, e.g., $50 per week, $100 per month, directly from your bank account into your brokerage account. Automation is key to long-term investing success. Step 7. Reinvest dividends. Important index funds often pay out dividends, small portions of company profits. Make sure to reinvest those dividends. Usually you can set this up automatically within your brokerage account to further accelerate the power of compounding. Reinvesting dividends is like, and that's it. Investing in index funds is not rocket science. It's simple, powerful, and accessible to everyone. Don't let complexity or fear hold you back from taking advantage of this incredible wealth-building tool. Index funds are your secret weapon for simple, effective, and low-cost long-term investing. Start small, be consistent, and let the power of compound interest and the diversification of index funds work their magic over time. Take action, open an account, and start investing in index funds today. But we are not done yet with equipping you for financial success. In Section 6, we'll continue to debunk even more money myths that might still be holding you back. Stay tuned.
We've just uncovered some of the most powerful financial principles that the ultra-rich use to build and protect their wealth. Now you know that. Billionaires don't think like the average person. They see money, risk, and opportunity differently. Index funds are a low-cost, long-term investment tool that can help anyone build wealth. The ultimate action plan for financial freedom is not just about knowledge, but execution. The question is, what will you do with this knowledge? Let's hear from you. What's the biggest mindset shift you took away from this video? Are you currently investing in index funds? Or are you just getting started? What's one financial habit you'll start changing today? Drop your thoughts in the comments. Let's have this conversation. Take the next step. If you found this valuable, share it with someone who needs to hear this. Subscribe to Economy for Everyone and turn on notifications so you never miss a step on your journey to financial freedom. Coming next, the myths that are still holding you back. Just when you think you've broken free from financial misinformation, there's even more dangerous money myths that keep people trapped in the cycle of struggle. Next time, we're exposing the hidden money traps that people fall into, even when they think they're making smart choices. The psychological secrets of wealth and abundance that billionaires use every day. Real-life stories of people who transformed their finances and achieved true financial freedom. Are you ready to break free from every last financial limitation and start building the life you deserve? Don't miss it. Stay tuned.